Hello everyone, welcome to your lecture for chapter 9 on consolidation. So in this lecture, we'll be recording again part of the videos in different segments based on the topics that we need to cover from chapter 9. So as you guys are focused on consolidation, this is probably be the last chapter we have on the consolidation. So we are going to talk about the different issues or different reporting scenarios that we can face in a consolidation examples. So I will go through this learning objectives before we start the detail of the topics that are discussed in chapter 9. As chapter 9 states, it's focused on other consolidations reporting issues. So we talked about that the investments the companies will have, and then based on the controls, we determine whether this is going to be recorded as a strategic investment, or it will be non-strategical investments, or it is a control. If it is a control, then we have to look at the reporting for consolidation purposes. And then we looked at the consolidation, how the consolidation work at the initial stage, and then what happened after that. Now when the consolidation happens, what are the reporting issues that the companies could face, and how do we tackle that for reporting purposes. We talked about the intercompany transactions, eliminating the unrealized gains and losses on inventory, and any sale and purchase that happens between the companies on the sale of land or the depreciable assets. We looked about the bonds as well, how the bonds works, and if the related companies purchase bonds from the market that was pre-issued by the other company, how does the amortization of discount or premium works, and how do we eliminate that. That was covered in chapter 8, chapter 7 actually. And now we are going to look at the other reporting issues that companies could face. And here are some of the learning objectives that we are going to go through. We are going to look at the implications of a special entity. We will look at the implication of a joint ventures, and then we understand the deferred income taxes. So we talked about the income taxes as we were going through, and how does it works at the time of the business combination and thereafter. We understand the segmental disclosures in reporting at the time of the reporting of financial statement. What are the different requirements, and what is the minimum you have to require, and what are the different criteria you have to meet in regards to the segment disclosures of the financial statement. And then we'll look at analyzing, interpreting financial statements, looking at the consolidating report. So first of all, we will start this by looking at the special purpose entities. So this probably be a new term for you, that there are special purpose entities. So what are those special purpose entities? So in the industry, in the corporate world, there is always so what the companies do is, instead of diversifying the risk, they may create special entities that are formed only for certain reasons, and the companies are only going to be doing what the reason of that purpose of that entity is. So if the company who actually has a full control creates such entities, then there are reporting issues that we need to look at. So so what is special purpose entities? So special purpose entities are the entities or corporations that are created for certain purposes. The purposes could be any, and then those are the examples that we are going to look through. And for reporting purposes, has been a lot of changes that happened since the IFRS came into effect. That those companies, prior to the new rules, they were only companies were required to just put a disclosures of the special purpose entities, and that would have been the only thing that was required. And then they will consolidate the numbers for the asset liabilities, and the user will have no idea what's happening with those entities. Now with the new rules under the IFRS, there are consolidation, there are disclosures that are required to be identified to the users when the special entities are involved. So let's look at what is the special entities. So special entity is an entity created to accomplish a very specific business activity. And now the specific business activity could be leasing a big equipment or borrowing a loan to finance certain activities that need to be performed. So in that case, what usually happens is there are some assets that gets transferred by the sponsors, and those sponsors could be the controlling entities or could be a non-controlling entities, and they are often used to secure some of the low debt financing. So if the company feel that there are high interest that need to be paid, what the companies may do is they will transfer some of the assets to a particular entity to show that the company has an assets, and then what that company will do is they will borrow the debt using those assets. Obviously, if they have a secured assets against that, it will end up taking a low debt, which will definitely save a lot of money in the companies for future purposes. Now, the company who will transfer those assets, what they will do is they will take some kind of a interest or a profit share from those special entities. So that's how this relationship could be built. With the debt proceeds, the SPE then will pay the sponsors for the transfer of the assets, and those monetary values could be liquidated as an asset, turning into a cash for the SPE. So these are some of the examples where these relationship could exist. Grantee of a debt. For example, if I'm a company who has a lot of assets and have a good financial background, I could just simply become a grantor of the debt. So you are putting your risk there, so therefore you will get some kind of money out of it. So that is why you are providing a grantee, and obviously you will get some kind of monetary compensation for that. If these relationships exist, then we will assume there is an SPE relationship. Sub, Subordinated debt instruments. So you will provide some kind of a debt seniority. So you will give a lower risk, lower debt to the company, and then obviously that will do up the relationship as well. Now, variable rate liabilities. Sponsor as a holder of debt may participate in return of the SPE. So what could happen is the company has a debt, and then it will sponsor some of the debt, which will provide a return to the SPE in either as a form of dividend or interest, and that could also be a relationship that's built. Leasing a residential granted. If the company wanted to lease an equipment, they can lease equipment and decline below sponsors as a lessee will be a shortfall. So if your company has a lease and they need a grantor, in that case what the company will do is it will become a grantor, and as well as the value of that asset decreases, the shortfall that it will arise, the other company who is providing a guarantee could fill up those shortfalls as it arises, and then against that they will receive either a monetary value, a fixed amount, or based on the percentage. Non-voting equipment. So sponsors as a holder of debt equity may participate in the residual profit. So what you can do is you can either issue a preferred shares that the company may don't want to give up their equity. In that case, you may want to give some kind of a non-converting equity instruments to the other companies, and then the SPE will still hold the equity as a voting shares, but it will still get an preferred shares equity invested. So therefore, there is no foundation for them to pay interest on the debt, but they will still pay a dividend, which may or may not be accumulated depending on the type of relationship or type of agreement that you will have with the sponsors. And the last but not the least is the services. You may end up providing certain services to the SPEs, and then you will receive either a profit against those services, or you could receive a fixed amount based on those services. Okay, that's So these are some of the things that could end up creating that relationship for the special purpose entities. If those does exist, then you have to follow the rules under the IFRS for reporting and disclosure purposes. So the main reason is that the relationship that exists is a risk and reward relationship. That's what the SPE determines. That's how we determine there's an SPE. So if there's a risk that you are taking, obviously you will get a reward out of that. If you will feel that that relationship exists, then there is a special purpose entities. So then if the primary risk of the rewards may not be based on the equity but rather on a variable interest conveyed by a contractual agreement. So for a special purpose entities, you're not primarily looking at the control from the equity prospect. The control could have been based on the contractual agreement or the arrangement that you have with those entities. So then there could also be an equity investors as well, but the equity investors typically receive a guaranteed rate of return as a reward of providing sponsorship or other primary benefits with the contractual agreement. So if there is an equity that exists and there is an equity investors, they will have a fixed reward, which is the rate of return they will get from the actual risk. And if there is no equity involved, then you will have a fixed amount that will either be paid out on a monthly or a quarterly basis. And if that is not the case, then you may end up taking the reward as the percentage of the profit from the companies as well. So under the IFRS 10, the consolidated financial statement, entity must consolidate the entity that it controls regardless of the mean of obtaining the control. So if there is a special purpose entity that exists for the consolidation purposes, you must do a consolidation. So many SPs are created to conduct an activity that are part of the reporting entity's ongoing activities. So when the SPCs are created, they are conducting some of the activities, and that's not just for a short period of time. It's always based on the ongoing activity that exists. So if that is the case, then obviously you will do a consolidation. So in regards to the risk, obviously the return directly varies based on the risk that you're taking. If you're taking the higher risk, obviously the risk of getting a return will be higher as well. So now how we determine the control. So in the previous examples or the previous chapter we talked about, we simply look at the controls either being controlling of getting a voting shares or having a control or making a decisions on the board members. That's how we dictate the control. But here the SPC usually have controls are determined based on the key activities. So if the primary reason of the company is leasing an equipment, and you have a control on who you're going to be leasing the equipment, where the financing are going to be coming in, if you are the key stakeholders making decisions, that means you have a control. So how we determine the SPE controls is based on the key activities of SPE and who make decisions on those activities. So if you have a control and will obtain the future return of these resources must meet the definition of an asset, should be included in the consolidated balance sheet of a primary beneficiary. So if you are expecting a future return, obviously this is considered to be an asset, which is an investment. So therefore it must be reported in the financial statement. So, and then if you're observing the risk of observing the majority of the expected losses of SPE, it is effectively assuming responsibility for the liabilities of the SPE as well. Therefore, these liabilities should be included in the consolidated financial statement as well. So now if we're looking at that we have to consolidate the assets, then obviously the consolidation of liability will exist as well, because you are taking a risk and you have the the liabilities that exist for the SPE, you are fully responsible and a grantor for that. So therefore those liabilities must be included in the financial statement as well, in a consolidated financial statement. So again, when we're doing a consolidation of the special purpose entities, there is 2 points when the consolidation happens. So first you have to look at the initial stage, what we have to do, and then what happened after that on a reporting period. So when the initial investment happens, when you are providing a grantee, you have to determine whether you are the only company who's involved, and if it is, then there is no NCI exist. If there are a non-controlling interest exists, then at the time of the measurement, at the time when this happens, you have to determine what the fair market value of uh, of the company is, and then that is determined based on the assets and liabilities of the SPI, and then you also look at the fair market value of the NCI at the time of the control, or at the time when you are when you building that relationship. So technically, we use the same rules that we have used in the consolidation, where we have implied method or the fair market value method. We still use the same concept to determine the value for the company and the value for the NCI. So when the primary benefits gets control of the net assets, and the total consideration given is the sum of the following. So it's the fair value of the consideration paid by the primary beneficiary, which is the company who is having a control, and the fair value of the NCI, and that becomes the total value. And after that, you will do the allocation of the acquisition differential, and then finally find the value of your goodwill as well, if it does exist. Okay, so you guys can read through these kind of notes. They are applied as same as we do apply for the business combination. I'm trying to see if there is anything different. So we use the same rule. If there's a negative goodwill, we recognize as a gain. If there isn't, it's considered to be a goodwill, and then it will be recognized and acquired, and the SP is not a business. So technically it will exist until the time that special purpose entity exists, and after it's dissolved, then it will be recognized either as a gain or a loss at the time when the company, the SPI, is being dissolved. Consolidation subsequent to the initial measurement. So what happened after that? So after the initial measurement of the consolidation, the primary entity should follow the same process as the entity will consolidate, being based on the voting interest. So the same rules will be applicable for the SPIs as it's applicable for the business combination. You will eliminate all the intercompany transactions and intercompany gain or losses. You will determine if there's unrealized gains and losses on some of the transactions that happens between the companies, and then if there is any acquisition differential assets that exist, you must amortize the same way that you were amortizing it for the business combination purposes. And now comes to the disclosures of the special purpose entities. So the primary benefit of the control, so definitely there are disclosures required under the IFRS 12. So you must put a disclosure what the primary relationship is between the companies, the sponsor and the special purpose entities, and provide what kind of controls exist and how you determine it is a special purpose entities, and what are the risks that results from that SPE. Okay, so the users you have a responsibility to the users to provide the information as what kind of risks exist, and provide all the detail over there. And in your chapter, there is an exhibit 9.2 that provides the horizontal examples of the SPEs that exist in Canada and worldwide as well. So you guys can look at through that in that example. So just an information that exists, and they actually put some of the information from one of the company, and they will show how the significant subsidies uh, the disclosures exist, and how many of those, and what kind of controls that exist, and how these disclosures are shown up on the financial statement. So I'm just looking at the exhibit 9.3. It is the exhibit that was taken from the company called Horizon North Logistics. They took our 2017 financial statement and they provide the disclosures about significant subsidies. So that's kind of a disclosure that is provided about the companies, and then there's a special note there for special purposes entities as well. So it's a good information. It kind of provides you how these disclosures works. Okay, so this ends up the special purpose entities, and I'm going to stop this video now, and the next video will focus on the joint ventures and how it impact the financial reportings.